We're joined now by Bloomberg Best analyst for both companies. Kotowski is the director of research at Oppenheimer Co. Welcome, Chris. Good to see you. Let's start with Wells Fargo, because I think that's the bigger surprise of the two. Were you caught off guard by their report this morning?
Well, the bottom line number came in more or less in line. And I'd say going into the quarter, expectations were really low for Citibank and pretty high for Wells Fargo, as you'd mentioned. And, I guess I would keep this in perspective in the sense that if you look at Wells Fargo's pre-provision earnings, that is, earnings before loan losses, they were $8 billion this quarter and they were $8 billion last quarter. And, so what happened is there was continued modest pressure on the revenue side. And this quarter it was more or less offset by a good performance on expense control. And I think what the market's disappointed in is that we saw some loan growth coming out of Wells Fargo this time. And, one would have hoped that it would have led to a little bit of revenue growth, too.
Now, this is a company, unlike a lot of the other banks that we talk about on a daily basis, a Citibank, a Morgan Stanley, a Goldman Sachs, a JP Morgan, isn't as exposed to what is happening to Europe, if at all, and certainly isn't as exposed to as much of the regulatory issues or change that's happening here in the U.S. Are we seeing something perhaps coming out of Wells Fargo, though, that doesn't now bode well, adds additional pressure to the other bank stocks?
Well, what you're seeing mainly, Wells Fargo is like a big, giant regional bank. It doesn't really have that globally interconnected wholesale, global investment bank. It looks just much more like a big, giant regional bank. It's just everywhere. So it's subject to the pressures that a lot of the regional banks are. And in particular, what that is that as interest rates have been coming down over the past year, that, slowly but surely, the bonds that they bought 2 years ago or 3 years ago, whatever, are rolling off and get replaced by lower spread assets. As you mentioned in your setup piece, they have a big deposit inflow. And the problem or the issue is that having deposits doesn't generate a lot of revenues unless you can put it to work in loans. And, where we are now is that loan growth is very slowly coming back. It is coming back, but not rapidly. And so as long as that's the case, there's going to be some pressure on net interest margins.
Well, you have an outperform on both this stock and Citi. You just lowered your price target, though, on Wells Fargo from $32 to $31. Do you see further revisions to that? And how does this factor into sort of your future estimates?
Well, it's, again, as I mentioned, when you look at it on a pre-provision core basis, it's not radically different from what I would have expected 2 weeks ago. And I don't imagine doing anything very radical with our outlook.
Chris, do you think the market's overreacting today, then, with the stock trading down, close to 7.5% when I last looked?
On this one, yes. I think that's safe to say. And I think with the banks in general, it's important to put it into the context of the market's down $200 today as well. That's
true, right? And we've been seeing, if anything, this market's been highly correlated, right? Or if nothing else, it's been highly correlated. Let's move on to Citigroup. Now, certainly their numbers, at least the headline, looked pretty good, but the stock is lower today. What did you take away from their earnings report?
Well, as with a lot of other places, the plain vanilla banking businesses are more or less chugging along. So if you look at Citibank's regional consumer banking business, it earned on a pre-provision basis about $3.5 billion, almost exactly what it earned last quarter. Where the shortfall is the wholesale banking group, what they call the securities and banking group. And on a pre-provision basis, it earned about, $1.3 billion, whereas the average for the last 6 quarters was over $2 billion. So there's weakness in anything that has to do with trading and investment banking, and we've seen that elsewhere at Jefferies and at JP Morgan that already reported, and I imagine we'll see it in spades tomorrow with Goldman.
Now, something specific to Citigroup, as with many of the large banks, is exposure to what is happening in Europe. Citigroup did report that they have a little bit more than $30 billion in exposure or at risk in France and Belgium. What was your takeaway from any comments on their conference call related to that?
Well, you know, they took you from those gross numbers to smaller net numbers as well, right? And again, there's collateral and hedges against that, and there are issues about how much you can trust that and how good all that is. But I think for the most part, people thought it was pretty decent disclosure. Not everything that you'd want, but it tells you that Citibank is probably not the most exposed to all of this. I think, though, the other thing, though, to put this into perspective is that, you know, the French and Belgian banking authorities decided to stand behind Dexia, and I think it's very, very unlikely that the French government would ever let any of their big flagship banks, you know, default on their counterparty exposure to U.S. and other banks.
Well, Chris, speaking of that, we've had three banks report thus far, three big banks: Wells Fargo, Citigroup, and JP Morgan. What do you expect from Morgan Stanley and Goldman Sachs, given what we've heard on those last three earnings calls?
Well, in general, if you break apart the market-sensitive items, you know, trading has been weak, but not catastrophic. What has taken a big hit are the private equity portfolios. They've been written down, and that's going to impact Goldman more than it would some of the other ones. So I think that's where you might see a bigger, more discontinuous, weakness. And then, you know, investment banking is weak. But the one point I'd make, actually, is that this can bounce back in an awful hurry. If you were sitting there at the end of 2008, you would have never guessed that first quarter of 2009 was going to be an all-time record quarter for trading. You know, the markets can turn quickly, and it makes sense to be cautious. It makes sense for the banks to be cautious and to be cautious on expenses and all that. But capital markets can turn very quickly. So I wouldn't count it. You know, I think, yes, fourth quarter is likely to be weak as well, but it doesn't necessarily tell you a whole lot about 2012.
All right, Chris, sounds like you're saying this could be a good opportunity to get in because things could turn around. You might be upset over missing the opportunity to buy at these depressed levels. Okay, we got to end it there. Appreciate you joining us, Chris. Thanks so much. That was Chris Kotowski of Oppenheimer Co. He's Director of Research, Bloomberg Best. He's got a $43 price target, by the way, on Citigroup.